The silver market is under pressure that most investors have never seen in their lifetimes, and the data coming out of COMEX and London right now is not something you can afford to ignore. If you hold physical silver, silver ETFs, or even gold as a hedge against inflation, what is unfolding in these markets will directly affect the value of everything you own. This is not a prediction. This is not a guess. This is what the numbers are already telling us, if you know how to read them. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Let's start with something that might surprise you. Silver is not just a precious metal, it is one of the most industrially critical commodities on the planet. And right now, the systems that control its pricing and delivery are experiencing a level of strain that the average investor has no idea is happening. COMEX, the commodity exchange, is the primary marketplace where silver futures contracts are bought and sold in the United States. For decades, it has served as the global benchmark for silver pricing. But here is what most people do not understand. The vast majority of silver traded on COMEX never actually results in physical delivery. Traders buy and sell paper contracts, promises to deliver silver at a future date, and most of those contracts are settled in cash before a single ounce ever changes hands. That system works perfectly fine when confidence is high, but when confidence starts to crack, when traders start demanding real physical silver instead of cash settlement, the dynamics of the entire market shift in ways that can be violent and fast. That is exactly what has been happening. COMEX silver deliveries, meaning the actual transfer of physical silver bars in exchange for expiring contracts, have been running at elevated levels for several consecutive months. This is not a seasonal blip or a statistical anomaly. Elevated delivery demand is a signal that participants in the market no longer fully trust that paper contracts reflect the real-world value of physical metal. When a trader who holds a futures contract chooses to take delivery instead of rolling over or cash settling, it means they believe the physical silver is worth more than the cash equivalent being offered. That is a profound shift in market psychology, and it has historically preceded significant price dislocations. At the same time, the data coming out of London is equally telling. London has long been the world's largest over-the-counter market for physical gold and silver. The London Bullion Market Association tracks silver vault holdings across the city's major custodians, and those numbers have been declining. When London silver vault holdings fall while COMEX delivery demand rises, it creates a squeeze, a narrowing gap between the supply of metal that can be physically delivered and the volume of paper contracts that theoretically represent that metal. Markets can absorb stress in one location. They struggle much more when two of the world's largest precious metals hubs are both showing signs of strain simultaneously. Here is the piece of context that almost never makes it into mainstream financial coverage. Silver has a structural supply deficit. Mine production has not kept pace with the growth in industrial demand, particularly from the solar energy sector. Photovoltaic solar panels require silver in their manufacturing, a fact that has turned the clean energy boom into one of the largest sustained drivers of silver consumption in modern history. The Silver Institute, one of the most credible organizations tracking supply and demand data in this space, has documented a multi-year trend of consumption outpacing mine supply. When you layer that structural deficit on top of the current dynamics at COMEX and in London, you begin to see why some analysts who have been quietly watching this situation are genuinely concerned. And yet, silver's price does not always reflect this reality in real time. That is one of the most frustrating and misunderstood aspects of precious metals investing. In the short term, silver's price is heavily influenced by forces that have nothing to do with physical supply and demand. The strength or weakness of the US dollar plays an enormous role. Treasury yields, the returns on US government bonds, compete with non-yielding assets like silver for investor capital, and when yields rise, money tends to flow away from metals. Oil prices affect mining operating costs and can shift sentiment across the entire commodities complex. These macro variables can suppress the silver price even when the physical fundamentals are screaming in the opposite direction. This is not a conspiracy. This is how complex financial markets have always worked. But it means that an investor who only watches the price ticker and ignores the underlying data is operating with an incomplete picture, and that incomplete picture can be very expensive. What you are watching unfold right now is a collision between the paper silver market and the physical silver market. These two markets are supposed to move together. The futures price is supposed to be an accurate forward-looking representation of physical supply and demand. But when they begin to diverge, when the physical metal commands a premium over the paper price, when delivery demand spikes, when vault inventories shrink, it is a signal that the paper market may be losing its grip on price discovery. That gap between paper and physical is called the basis, and when it moves into a state called backwardation, where the spot price for immediate delivery is higher than the futures price for future delivery, it is one of the clearest signals in commodity markets that physical supply is genuinely tight. And what the data is currently showing is that silver is brushing up against exactly that condition. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Now let's go a level deeper, because this is where most financial commentary stops, and where the real understanding begins. The relationship between COMEX and London is not just logistical, it is structural. These two markets are connected through a complex web of leasing agreements, swap arrangements, and custodial relationships that allow metal to flow between them depending on where demand is highest. Under normal conditions, this system is fluid and self-correcting. Metal moves to where it is needed, prices stay in alignment, and confidence is maintained. But when both markets are simultaneously showing stress, that self-correcting mechanism breaks down. The pipelines that move metal from London vaults to COMEX warehouses and back again can only absorb so much pressure before the flow slows and the system strains. There is a specific number that has been drawing quiet attention from professional traders and independent analysts: the ratio of paper-silver contracts to registered physical silver in COMEX warehouses. Registered silver is the metal that has been certified as deliverable. It is sitting in approved vaults, tagged and ready to be transferred to anyone who stands for delivery. When that ratio climbs above historical norms, it means there are far more paper claims on silver than there is physical silver available to settle those claims. The ratio has, at various points in recent history, reached levels that, if applied to any other asset class, would be described as dangerously over-leveraged. Imagine a bank that held $1 in reserves for every $100 in deposits. That is the kind of mismatch we are talking about, and it is the kind of mismatch that, when confidence breaks, can unravel quickly and dramatically. And this is where most people stop reading, stop watching, stop paying attention, but the ones who stay are about to understand something that could completely change how they see their money. The counterintuitive truth about silver's price suppression is this: the very mechanism that has kept silver's price artificially low for extended periods of time may also be the mechanism that causes the most explosive upward move when it finally breaks. Large financial institutions hold what are called short positions in silver. They have sold contracts promising future delivery of silver they do not currently own. This is a legal and common practice in commodity markets. But the scale of the short position in silver, relative to the size of the physical market, is extraordinary. The Bank for International Settlements, which publishes data on over-the-counter derivatives, has reported figures suggesting that the notional value of silver derivatives vastly exceeds the value of all the silver ever mined in human history. Let that settle for a moment. The paper market for silver is orders of magnitude larger than the physical market it is supposed to represent. This disconnect exists because most participants in the paper market never intend to take delivery. They are speculators, hedgers, and algorithmic traders who use silver futures as a financial instrument, not as a means to acquire actual metal. And as long as the vast majority of them continue to roll their contracts or settle in cash, the gap between paper and physical stays manageable. But sentiment can shift, demand for physical delivery can rise, and when it does, the institutions sitting on massive short positions face a choice: either source the physical metal to deliver, or buy back their contracts at whatever price the market demands. That buying pressure multiplied across thousands of short positions unwinding simultaneously is what produces the kind of price spike that rewrites history books. We saw a preview of this dynamic in early 2021, during what became known on social media as the retail silver squeeze. Individual investors, coordinating through online platforms, began buying physical silver and silver ETFs in an attempt to trigger exactly the kind of short squeeze we are describing. The price of silver surged sharply over a matter of days. What most people remember is that the squeeze ultimately faded. What fewer people noticed is that COMEX inventories dropped noticeably during that period, and premiums on physical silver, the markup over spot price for actual coins and bars, spiked dramatically and stayed elevated for months afterward. The paper price recovered. The physical premiums told a different story. They told the story of genuine sustained demand for real metal, at a time when the paper market was trying to tell everyone that nothing unusual was happening. The London vault drawdowns we are seeing now are happening without a coordinated retail campaign. This is organic. This is institutional. This is the kind of slow, steady pressure that does not make headlines until it suddenly does, and by the time it makes headlines, the move has already happened. The macro backdrop is not helping either. Central banks globally have been accumulating gold at rates not seen in decades. That accumulation reduces the opportunity cost of holding precious metals across the board. When sovereign nations are buying physical gold as a reserve asset, it validates the thesis that hard assets hold value through cycles of monetary instability. And silver, which has historically tracked gold but with higher volatility on both the upside and the downside, tends to lag gold during the early stages of a precious metals rally, then accelerate sharply once it catches up. That pattern of lagging and then sprinting is well documented in historical precious metals cycles, and it is precisely the setup that sophisticated investors monitor when they are positioning for the next major move in silver. So after everything we have walked through, the COMEX delivery data, the London Vault drawdowns, the paper-to-physical ratio, the short position dynamics, the macro forces, what does a thoughtful investor actually do with this information? That is the question I want to spend the final part of this video answering clearly and honestly, because information without a framework for action is just anxiety in a different form. The first thing to understand is context. The situation we have described is real. The stress signals are genuine, but stress in a system does not guarantee an immediate resolution, and it certainly does not guarantee a specific timeline. Markets can remain irrational, or at least can remain misaligned with fundamentals, for longer than most people expect. The short squeeze we described, the mechanism by which a mass unwinding of short positions could drive an explosive silver rally, requires a catalyst. That catalyst could come from a large institution failing to deliver on a contract. It could come from a geopolitical event that disrupts supply chains. It could come from a sudden surge in industrial demand that overwhelms existing inventory. Or it could come from a broader loss of confidence in fiat currencies that drives a flood of capital into hard assets. Any of these could serve as the spark. None of them is guaranteed to happen on any particular schedule. What you can do as an investor is position yourself thoughtfully so that when that catalyst arrives, you are already holding the asset, rather than scrambling to buy it at a price that reflects the panic of everyone else realizing they should have bought it earlier. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The second principle is diversification within the precious metals space itself. Physical silver and gold are not the same asset. They move differently, they serve different purposes, and they carry different risk profiles. Gold is primarily a monetary metal. Its demand is driven by central banks, reserve management, and investors seeking a store of value. Silver is a hybrid, part monetary metal, part industrial commodity. That hybrid nature gives silver a different return profile than gold, and means that the forces acting on its price are more complex. A balanced approach that includes both physical gold and physical silver, held in allocated, segregated storage, or in your own possession, gives you exposure to different aspects of the precious metals thesis without concentrating all your risk in one form of the asset. The third actionable takeaway is this: pay attention to the premium over spot for physical silver. When the paper price and the physical price diverge, when you are being asked to pay a significant markup above the COMEX spot price to actually acquire physical metal, that premium itself is data. It is telling you that physical demand is outpacing the paper market's representation of supply and demand. Historically, periods of elevated physical premiums have preceded significant upward movements in the paper price, as the gap eventually narrows, not by physical prices falling back to paper, but by paper prices rising to meet the physical reality. Tracking this spread is one of the simplest, most accessible ways for an individual investor to monitor the health of the silver market without needing access to sophisticated financial data terminals. Now let's talk honestly about the emotional dimension of all of this, because the fear of getting this wrong is real, and it deserves to be addressed directly. Many people who are drawn to precious metals are not doing it out of greed. They are doing it out of a genuine, deeply felt concern for the safety of their financial future. They have watched inflation erode the purchasing power of their savings. They have seen market crashes wipe out retirement accounts built over decades. They have read about the fragility of banking systems and the extraordinary levels of debt that governments around the world are carrying. That concern is rational. The instinct to hold assets that exist outside the financial system, assets that cannot be printed, cannot be diluted, and cannot be defaulted on, is a deeply human response to a world that has made the paper promises of institutions feel less reliable than they once did. What I want you to take away from this video is not fear. Fear is not a strategy. What I want you to take away is clarity, a clear understanding of what is actually happening in the silver market, why it matters, and how to think about it in the context of your own financial life. The COMEX delivery data matters because it signals a shift in confidence between paper and physical. The London Vault drawdowns matter because they reduce the cushion of metal available to absorb that shift. The macro forces, the dollar, Treasury yields, central bank gold buying matter because they set the stage on which this story will ultimately play out. And the short position overhang matters because it represents stored energy in the system, energy that when released, historically produces some of the most powerful price movements in any commodity market. You do not need to panic. You do not need to liquidate everything and rush into silver tomorrow. What you need is to be informed, to have a plan, and to understand what you own and why you own it. The investors who fare best through major market transitions are rarely the ones who reacted the fastest. They are the ones who understood what was coming before it arrived, positioned themselves deliberately, and held with conviction when the short-term noise tried to shake them out. That is the standard. I hope this video has helped you hold yourself too, because you deserve to make decisions about your money with your eyes fully open. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.